On April 18th, the president and CEO of the Federal Reserve Bank of St. Louis, James Bullard, gave a speech in which he said he wouldn't rule out a 75 basis point move and that he wants 3.5% short-term rates by the end of the year. Now, as market expectations have increased for Fed actions, the U.S. two-year yield has moved from 2.29% to 2.54% just in the last 6 days and has risen from 0.2% to the current level over the last 7 months. The recent wave of aggressive Fed rhetoric comes at a time when the yield curve remains very flat, leading some to believe that this metric is signaling that the Fed may be too tight already, and that global supply chains are being damaged from pandemic shutdowns in China and geopolitical unrest in Russia. Now, the question that analysts and traders have asked is, has the Fed grown too myopic in their desire to calm inflation, and are they ignoring some signs that the economy may be potentially slowing on its own in the coming months? If a trader believes that the Fed aggressiveness will accelerate and that two-year yields could continue higher, they could buy the CME April Micro two-year Treasury yield futures contract at a current level of 2.6 and target the 2019 highs of 3.00%. A stop for this trade could be placed just below the April 13th lows at 2.25. This trade would make $400 if your target is reached and risks $350 if you're stopped out at your level. Now, if a trader believes that the Fed has been too aggressive in their signaling of rate hikes and that they soon may pivot and allow rates to fall, they could express that by selling the CME April 2-year Treasury yield futures contract at 2.6 and target a return to those April 13th lows of 2.29. A stop for this trade could be placed above the April highs at 2.7. This trade could make $310 if your target is reached and risks $100 if you're stopped out at your level.